This is an introductory course, designed for a beginner that has no prior accounting knowledge and wants to start learning financial accounting. This course will introduce you to the basic concepts that one must grasp in order to start learning accounting. Specifically, we will cover the following topics. We will answer the question of what is accounting. We'll introduce you to the chart of accounts and go over different types of general ledger accounts that make up the chart of accounts. We'll go over the elements of the accounting equation, as well as discuss the purpose and significance of this equation. We'll introduce you to the concept of the double-entry accounting system. We'll go over T accounts and illustrate how they work. We'll learn about accounting periods and accounting methods. We'll then introduce the concept of debits and credits, and we'll go over the rules on how they are applied to create accounting entries. After that, we'll go over numerous examples to practice using debits and credits to create journal entries. We will book 10 different journal entries based on a hypothetical example. That should give us a healthy dose of practice. Finally, we'll take a look at how booking all these journal entries affects our financial reports, and we'll go over the main financial statements. By the end of this course, you should develop basic knowledge of financial accounting concepts. Let's get started. Accounting is the language of business. But what exactly does that mean? Well, the purpose of any language is communication. The structure of any language that people use is comprised of words and sentences. When these sentences are put together, it enables the parties to communicate with one another and get their point across. Since accounting is the language of business, its purpose is to communicate what is happening with the business, to supply information on business activity, and provide a clear picture of the financial position and performance of the company. And just like the structure of a human language is comprised of words and sentences, accounting also has its own structure. The structure of accounting is comprised of 3 types of elements: accounts, debits and credits, and an entry. Accounts provide a way to categorize and organize business activity based on the transaction type. As the entries are posted to these accounts throughout the accounting period, the accounts are used to accumulate amounts from business transactions. There are different categories of accounts, and all these accounts are reflected on the chart of accounts. We'll go over the chart of accounts in detail a little later in the video. Debits and credits, which are applied to accounts. We'll go over these in detail later in the video as well. Entry, and an entry, such as a journal entry, which is comprised of debits and credits that are applied to the accounts to record transactions and accumulate amounts within the accounts. In a way, an entry can be compared to a sentence within a human language. Any business transaction that takes place needs to get recorded with an entry. This entry is comprised of 1 or more debits and 1 or more credits, which are applied to the accounts that are reflected on the company's chart of accounts. These entries then get posted and make their way to financial reports. It is these financial reports that will be used by business stakeholders such as investors and creditors to make financial decisions. You will also need accurate financial statements to prepare a tax return for the company. That is why accounting is called the language of business. It's the means of communicating what's happening in any company. Another way to describe accounting is the process of taking all the business activity and turning it into meaningful information that decision-makers such as business owners and creditors will then use to make important decisions. And so, the ultimate goal of accounting is to provide vital information to business stakeholders. Chart of accounts is an organized listing of all the accounts that a company uses to record its transactions. As mentioned before, accounts provide a way to categorize and organize business activity based on the transaction type. As the entries are posted to these accounts throughout the accounting period, the accounts are used to accumulate amounts from business transactions. This, in turn, will allow us to present totals for these accounts on different financial statements. All of this will become more clear when we go through actual examples and illustrate the process later in the video. It's important to note that the accounts on the chart of accounts are organized by type. It is critical to get to know and understand these types. The types are assets, liabilities, owner's equity, revenues, cost of goods sold, and expenses. Let's provide an explanation on each account type. Assets are resources that a business owns. Some examples of assets are funds in the bank account of the company, accounts receivable, Inventory and buildings and machinery. Liabilities are present obligations of a business to make payments on loans, transfer assets, or provide services. Some examples of liabilities are accounts payable, loans payable, and accrued expenses. Owner's equity represents claims by owners of the company to the assets of the company, after deducting the liabilities. In other words, the owners of the company usually don't have claim to all the assets. If the company has liabilities, debt on its books, the debt holders usually have priority over owners to the assets of the company. As such, equity measures the residual interest of the owners in the assets of the company. Equity increases from net income and investments by owners into the company. Equity decreases from net loss and distributions to the owners of the company. Revenues are income from conducting business operations. And then we have cost of goods sold. It's important to distinguish the cost of goods sold account from expenses. Cost of goods sold is the cost of your product. When a merchandising company purchases a product to sell, they will first code it to the inventory account on their books. Later on, when this product is sold, an entry is used to transfer the associated amount to cost of goods sold account. Expenses are outflows incurred as a result of conducting business operations. To keep things organized and make it easier to work with the accounts, they will usually be numbered on the chart of accounts. The accounts are numbered according to their type. While each account on the chart of accounts will be assigned a unique number, all accounts that belong to a specific type will begin with the same number. This makes it much easier to organize them by account type. For example, for the asset type accounts, the first asset account will be assigned the number of 100. The second asset account will assign 101, and so on. While this is not in stone, typically the accounts are numbered as follows. Assets will start with number 1. Liabilities will start with 2. Owner's equity will start with 3. Revenues, or income, will start with 4. Cost of goods sold will start with 5. And expenses will start with number 6. Make sure to note that in order to perform the accounting function efficiently, it's very important to have an organized chart of accounts. As part of learning the basics of accounting, it is crucial to understand the accounting equation. The accounting equation states that total assets of the company equal liabilities plus owner's equity. Let's think about it for a second. Assets equal liabilities plus owner's equity. This equation basically states that total assets of the company are equal to total claims on those assets. And there can be two types of claims. Liabilities, which are claims of the creditors against the assets of the business, and owner's equity, which are residual claims of the owners against the assets of the business. What this equation states is that total assets equal total claims of creditors plus total claims of owners of the business. Another way to look at it, to better understand and remember this equation, is to say, the left side of the equation represents the assets owned by the company. And then ask yourself a question. Where did we obtain the resources to pay for these assets? Well, it was a combination of borrowing funds from creditors, which are your liabilities, and funds obtained from the owners of the company. That's your owner's equity. In other words, the left side of the equation, which is assets, equals the right side of the equation, which are the sources of funds to obtain these assets. And that's how we get to the following equation. Assets equal liabilities plus owner's equity. It's important to understand and remember this equation. Later in the video, we'll be going over 3 major financial statements. As you will see, the balance sheet, which is one of the 3 major financial statements, is based on this accounting equation. Double entry accounting system. This will just be a quick introduction to the double entry accounting system. We will explore this concept in much greater detail later in the video, when we introduce the topic of debits and credits. All of financial accounting is based on the double entry accounting system. The term double entry comes from the dual effect that each transaction has on the accounting equation. In your accounting system, you'll be recording each business transaction with an entry, and each accounting entry will have at least 1 debit and 1 credit. And every entry has to balance in a way where the total dollar amount of all debits has to equal the total dollar amount of all credits within that entry. It is because each entry must have at least 1 debit and 1 credit that they call it the double entry system. We will go into the concept of the double entry accounting system in much greater detail when we discuss debits and credits. This is actually a good time to introduce T accounts. T accounts are a great tool for analysis of your entries, and they are also very useful for illustration purposes when learning the basics of financial accounting. The reason it's called a T account is because it looks like a letter T. A T account is comprised of the following elements. A title on top. This title reflects the name of the general ledger account. Left side of a T account, where you will enter your debits. Right side of a T account, where you will enter your credits. T accounts accumulate all the debits and credits that pertain to a particular account over a specific time period. As you'll see later on, they are a great tool for analysis of your accounting entries. We'll employ T accounts later in the video as we progress through our study of financial accounting. Let's introduce an important concept of an accounting period. Accounting period is a range of time over which the company reports its operations. The 12-month accounting period is called a fiscal year. Many companies follow the calendar year for their accounting period. Others choose accounting period based on their business cycle. Companies also may report on monthly and quarterly basis. These are called interim periods. In accounting, it's very important to record each transaction in the proper accounting period. Ultimately, all recorded transactions flow into the financial statements. These financial statements may be monthly, quarterly, or for the entire year. The data in these financial statements is presented based on dates. The financial statements present information either for a specific time period or as of a certain date. For these financials to reflect accurate figures and present a true picture of the company's profitability, each entry has to be recorded in the same accounting period as the economic transaction based on which the entry was booked. Your accounting method determines when to recognize revenue and expenses for your company. As such, it will affect the data reflected on your financial statements and results of operations of your business. There are two main accounting methods, cash method and accrual method. First, let's discuss the cash method of accounting. Cash method is the simpler of the two. Under cash method of accounting, income is recognized when cash payments are received from a customer. Expense is recognized when a cash payment is made. Net income or loss is calculated as the difference between cash receipts and cash payments over a specific time period. Contrast that with accrual method of accounting. Under accrual method of accounting, revenues and expenses are recognized based on when the economic events takes place, rather than based on when the related cash payments are made. In other words, revenues are recognized when earned, not when the cash is received. Expenses are recognized as they are incurred, rather than when cash is paid. A natural question arises. How do you know when revenue is earned? What criteria do you use to make that determination? Well, there are two criteria that have to be satisfied for revenue to be earned under the accrual method of accounting. 1. The earnings process is complete. And 2. There is reasonable certainty with regard to collectability. Basically, in order to decide when to recognize revenue, we're looking for a point at which all the work has been done. And because there are different types of businesses, the point of revenue recognition will depend on the specific type of business that you're dealing with. For a service business, it's usually when the service has been performed. For an online business that ships products, it's usually when the product is shipped. Under the accrual method of accounting, it is at the point where the economic event criteria has been satisfied that revenue should be recognized. And again, under this method, we recognize revenue without regard to when you will actually receive the cash payment. The timing of cash payment is irrelevant. Switching our attention to expenses now, let's give an example of what it means to recognize expenses as they are incurred, rather than when cash is paid. Let's say you have someone that uses accrual method of accounting. Let's say they receive a legal bill from their attorney for the work that was performed in December. However, they plan to wait a couple of weeks and pay this bill in January of the following year. Since they use accrual basis of accounting, they shouldn't wait to pay this bill to recognize the expense. It's all about when the legal team performed the work. That is the time period in which they should recognize the expense. Paying the bill is irrelevant when it comes to expense recognition, if you're on the accrual basis of accounting. So, it's fine to hold off and pay this bill in January. But they have to recognize this legal expense in the month of December. Most small businesses prefer to use cash basis. The primary reason for that is that while cash basis is less accurate in presenting the economic performance of the company, it's much easier to administer in terms of accounting. On the other hand, most medium and larger size businesses use accrual method of accounting, as opposed to cash method. This is because it presents a much more realistic picture of company's performance. All that we learned in this video so far brings us to the discussion of debits and credits. And the first question we should ask is, what are debits and credits? A debit means that an entry is made on the left side of the ledger. A credit means that an entry is made on the right side of the ledger. Debits and credits are used to increase and decrease the balances within accounts. A person that is new to this topic will usually ask the following question: does a debit increase or decrease an account balance? Does a credit increase or decrease an account balance? And the answer is that it depends on the account type. It's critical to understand that a debit or a credit can both increase or decrease the account balance based on the account type. I promise you that we can make sense of this. And to make sense of it, we'll need to go back to our accounting equation. The accounting equation states, assets equal liabilities plus owner's equity. There are specific rules which dictate based on the account type whether debits and credits represent an increase or a decrease in that account. Let's list these rules. Assets increase with a debit and decrease with a credit. Debits and credits have the opposite effect on liabilities and owner's equity. Liabilities and owner's equity accounts decrease with a debit and increase with a credit. Expenses and losses increase with a debit and decrease with a credit. Revenues and gains decrease with a debit and increase with a credit. Just listing out these rules makes it really hard to understand what is happening and makes it very difficult to remember them. Yet this is critical to understand because all of the financial accounting is based on these principles. But don't worry, we will approach this in a way that will make it much easier to understand. Specifically, in order to provide clarity on how the rules for debits and credits work, we'll introduce a diagram. This diagram is based on our accounting equation. After we go over this diagram, things should make more sense. This diagram lays out a T account below each element of the accounting equation. Each T account, in turn, shows whether debits and credits increase or decrease that type of an account. It shows you the effects of debits and credits on assets, liabilities, and owner's equity. Notice that the T accounts for expenses and revenues are below owner's equity, with an arrow pointing towards it. That is because expenses, losses, revenues, and gains flow into owner's equity. Don't just try to memorize this. As you'll study this diagram, you'll notice that there is a specific logic to it. Specifically, you may notice the following important relationship. The way debits and credits affect different account types is consistent with the specific side of the accounting equation these accounts appear on. Our accounting equation has assets on one side and liabilities and owner's equity on the other. Well, the way that debits and credits affect different account types depends on which side of the accounting equation these accounts are on. In other words, assets, which are on one side of the equation, increase with a debit and decrease with a credit, whereas debits and credits have an opposite effect on liabilities and equity, which are on the other side of the equation. Liabilities and owner's equity accounts decrease with a debit and increase with a credit. As mentioned before, revenues and expenses flow into owner's equity. As such, revenues and gains decrease with a debit and increase with a credit, just like owner's equity. Expenses and losses have the opposite effect. They increase with a debit and decrease with a credit, because they decrease owner's equity. These concepts may seem challenging at first. The only way to get comfortable with this is to get a lot of practice. As such, next we'll go over the process of recording 10 journal entries, based on 10 hypothetical business transactions. To practice what we've learned so far, we will now book 10 journal entries. These entries will reflect 10 business transactions that took place within a new hypothetical small business. There is a young, ambitious entrepreneur, and he decides to open a new company. We will call this company Hypothetical Consulting Firm. Let's take a look at the business transactions that will take place next, and the journal entries that will be used to record those transactions. A company needs capital in order to operate. So the first thing our business owner did was he invested $4,500 into his new business. We need to come up with a journal entry to record this. Let's analyze this transaction so we can properly record our entry through debits and credits. And let's approach this as follows. Ask yourself a question. What did the business receive? Well, the business received cash. Cash is an asset. It's something that a business owns. And in our situation, it has increased as a result of this transaction. Now ask yourself a question. Do we record an increase in cash with a debit or a credit? If you don't remember, that's fine. We're doing this to learn and practice. To help us understand, let's go back to our illustration of the accounting equation. It shows us that assets increase with a debit. So that's the way we'll record an increase in cash. We'll debit cash for $4,500. Now we know that within any journal entry, there should be at least one debit and one credit. And the total of all debits must equal the total of all credits. We have determined what the debit should be in this entry. So the next question we should ask is, what's our credit? Let's think about it. As a result of this transaction, the company's cash position has increased. So the question to ask is, who provided this cash? Well, this cash was provided by the owner of the company. So the owner's interest in the business has also increased as a result of this investment. And as we've learned a little earlier in accounting, the owner's interest in the business is represented by the owner's equity account. So the other account that should be increased is owner's equity. And then the question becomes, should we debit or credit owner's equity within this entry? Now we know it's going to be a credit, because we were looking for an offset to a debit. But since our purpose is to learn and practice, let's ignore that fact and evaluate this scenario the proper way by looking at our accounting equation illustration. In our situation, we have an investment by owner, which increased the owner's equity in the business. Looking at our illustration, we can clearly see that equity accounts increase with a credit, so we'll need to credit an owner's equity account. We'll credit an account called Owner Contributions for $4,500. Owner Contributions is an owner's equity type account. So again, to record this transaction, we'll debit cash for $4,500, as increases in assets are recorded with a debit. And we'll credit owner's equity for $4,500, as increases in owner's equity are recorded with a credit. And here's how our journal entry will look. Let's take a moment and point out a few things regarding this journal entry. It's important for every entry to have a date. In accounting, everything is driven by date. As you'll see later, these entries make their way to the financial statements. And when you run financial statements, they are always based on dates. So for the financials to reflect accurate data, it's critical for every entry to reflect a correct date. Our debit is recorded on the left side of the entry, as to debit something literally means to record it on the left side. Both the name of the account and the amount are recorded to the left. Our credit is recorded on the right side of the entry. Also, every entry should reflect a memo that provides explanation on the transaction that's being recorded. In our case, we're recording an investment by owner, so that would be our memo. Finally, we need to post this journal entry to respective T accounts. As you may remember from a previous lesson, T accounts accumulate all the debits and credits that pertain to a particular account over a specific time period. They are a great tool for analysis of your entries. So we'll post a debit to cash for $4,500, and we'll post a credit to owner's contributions for $4,500. The balances within the T accounts will accumulate, as we'll post more entries, and will show us the detail of the balance of each account. Let's move on to the next transaction. The next transaction that took place is that the business owner signed a lease for office rent and processed a payment of $4,000 to the landlord. This payment comprised of a $2,000 security deposit and $2,000 payment for current month rent. Let's analyze this transaction so we can come up with a journal entry. This $4,000 that was paid by the business. What exactly was this for? Well, it was for two things. Of the total payment, $2,000 went towards a security deposit. A security deposit is an asset. Assuming the office is in good condition, it's expected to be repaid back to the tenant at the end of the lease term. Assets increase with a debit. So we'll debit a security deposit account for $2,000. Notice that this debit is only for $2,000, whereas the payment was made for $4,000. Obviously, we'll need one more debit to account for the other portion of the payment. The other $2,000 was paid for current month rent. That's an expense, and expenses increase with a debit. So we'll debit rent expense for $2,000. Our total debits now equal $4,000. Then we'll look at what the business gave up in exchange for getting this security deposit and 1 month rent. The business paid $4,000 cash. Cash is an asset, and assets decrease with a credit. So we'll credit cash for $4,000. So, here is our journal entry to record this transaction. We'll debit security deposit for $2,000. We'll debit rent expense for $2,000. And we'll credit cash for $4,000. Finally, we need to post this journal entry to respective T accounts. After posting this journal entry to T accounts, we can see that we only have $500 of cash left. This can present serious constraints on the ability of our business to operate. As such, we have to look into additional methods of financing as soon as possible. Next, this company purchased computer equipment with total cost of $1,800. This equipment was purchased on credit, with terms of 30 days. Let's analyze this transaction. When a business makes a purchase, in order to account for it properly, a decision has to be made on whether this is an expense or an asset. The main criteria in making this decision is whether this item is expected to be used up within the next accounting cycle. Usually that means within the next year. If it will be used up within the next year, then it's an expense. However, if it's expected to benefit the business for a number of years, then it's an asset. Computer equipment is not something that is expected get completely used up within the next year. As such, it's not an expense. It's an asset that will benefit our business for a number of years. Assets increase with a debit. So we'll debit computer equipment for $1,800. Keep in mind that we didn't pay for this purchase with cash. Rather, we bought this on credit with terms of 30 days. When you purchase items on credit, a liability account called accounts payable will increase. Liabilities increase with a credit, so we'll credit accounts payable for $1,800. To record this transaction, we'll debit computer equipment for $1,800, as increases in assets are recorded with a debit. And we'll credit accounts payable for $1,800, as increases in liabilities are recorded with a credit. Finally, we need to post this journal entry to respective T accounts. Let's move on to the next entry. Next, our company purchased office supplies for cash. Total cost of supplies is $370. Let's analyze this transaction. Office supplies are reasonably expected to be used up within the next accounting cycle. So this purchase is an expense. Expenses increase with a debit. So we'll debit office supplies expense for $370. We paid for these supplies in cash. Cash is an asset, and assets are decreased with a credit. So we'll credit cash for $370. So here is our journal entry. Debit office supplies for $370 and credit cash for $370. The only thing left to do is to post this entry to the T accounts. Here is what that will look like. As mentioned before, T accounts are a great tool for analysis because they enable us to monitor the balances of our accounts. For example, the T account for cash clearly illustrates that after 3 transactions that pertain to this account, our balance of cash has been depleted to the point where there is only $130 left. This should alert the business owner that he must raise more cash immediately. This is why it's so important to monitor and analyze your account balances. Next, our company purchased various professional publications on a credit card. Total of this purchase was $1,270. We will expense this to professional materials. An expense is increased with a debit. So we'll debit professional materials expense for $1,270. Next, we should ask ourselves a question. How did we pay for these professional materials? Well, we put it on a credit card. Credit cards, payable is a liability account, and liabilities increase with a credit. So we'll credit cards, payable for $1,270. And here is our journal entry. We'll debit professional materials for $1,270, and we'll credit cards payable for $1,270. Finally, we need to post our entry to the T accounts, and we're all done with this entry. As mentioned previously, our company is running low on cash, and our business owner made a decision to take a $5,000 loan from a bank. Let's analyze and record this transaction. What did the business receive? Well, the business received $5,000 in cash. Cash is an asset, and assets increase with a debit. So we'll debit cash for $5,000. In return for receiving this cash, the business took on an obligation to repay it back to the bank in the future. This is a liability. The account for this liability is called loans payable. Liabilities increase with a credit, so we'll credit loans payable for $5,000. And here's our journal entry. Debit cash for $5,000 and credit loans payable for $5,000. Make sure to post this entry to the T accounts. Here is what that will look like. Looking at our cash T account, we can see that after taking out this loan, our company has a healthy balance of cash and enough liquidity to continue business operations in the short term. Next, we purchased office furniture on credit with terms of 30 days. Total purchase was $2,700. Let's analyze this. Office furniture is definitely something that we expect to use for several years. So it's an asset. Assets increase with a debit. So we'll debit furniture and fixtures account for $2,700. This furniture was purchased on credit with terms of 30 days. When a business purchases things on credit with terms to repay at a later time, this increases an account called accounts payable. Accounts payable is a liability, and liabilities increase with a credit. So we'll credit account payable for $2,700. And here's our journal entry. Debit furniture and fixtures for $2,700. And credit accounts payable for $2,700. Make sure to post this entry to the T accounts. Here's what that will look like. And we're all set with this entry. The next event that took place in our business was that we performed some consulting projects for our clients. After the work was completed, we generated and sent out several invoices for a total of $5,000 for consulting work performed. Let's analyze this transaction. When a business issues an invoice to their customer, there is an increase in an account called accounts receivable. Accounts receivable is an asset, and assets increase with a debit, so we'll debit accounts receivable. What about the other side of the entry? Before we answer that question, we need to review something very important that we learned in one of the previous lessons, as it applies to our current situation. There are two methods of accounting, cash and accrual. Under the cash method of accounting, you recognize income when you receive cash from your customer. However, under the accrual method of accounting, you recognize income when it's earned. Under the accrual method, the point at which you'll receive cash payment from your customer is irrelevant. Income is earned when the work has been performed. Since our business uses an accrual basis of accounting, the other side of the entry is to recognize income for the work that's been performed. Income increases with a credit, so we'll credit consulting income for $5,000. And here is our journal entry. Debit accounts receivable for $5,000 and credit consulting income for $5,000. All that's left to do is to post our entry to appropriate T accounts, and we're all set. Next, we paid a $1,800 bill, which was already reflected in our accounting system. This bill is for computer equipment that we purchased on credit earlier in the month. Let's look at this transaction and make sense of what is happening. When this bill was originally received and entered into our system, we credited accounts payable, because our liability increased at that time. Now that we're paying this bill off, our accounts payable will decrease. Accounts payable is a liability, and liabilities decrease with a debit. So we'll debit accounts payable for $1,800. What about the other side of the entry? Well, we're making a payment for this bill, so our cash will decrease. Cash is an asset, and assets decrease with a credit. So we'll credit cash for $1,800. And here is our journal entry. Debit accounts payable for $1,800 and credit cash for $1,800. Make sure to post this entry to the T accounts. As you can see from the T account for cash, while our cash balance is still healthy, it did decrease substantially as a result of this latest transaction. As such, we should monitor the balance in this account closely as more transactions are booked. Next, we received a $1,000 payment from a client on one of our outstanding consulting invoices. Since we received a payment, our cash balance will increase. cash is an asset, and assets increase with a debit. So we'll debit cash for $1,000. Since our client made a payment, they no longer owe that money to us. This will decrease our accounts receivable associated with that client. Accounts receivable is an asset, and assets decrease with a credit. So we'll credit accounts receivable for $1,000. And here is our journal entry. Debit cash for $1,000 and credit accounts receivable for $1,000. Make sure to post this entry to the T accounts. This was journal entry number 10, which is the final entry in this presentation. Hopefully, going through these examples has improved your understanding of how to book entries. This concludes our introduction to journal entries. When you run a business, you need to evaluate the financial performance of that business. This way, you know where you stand and can make intelligent business decisions. And then a logical question arises. How do you evaluate the financial performance of a company? How do you determine whether a company was profitable over a certain period of time? How do you know if a business has had a positive cash flow from operations or what the value of their assets was compared to the value of their liabilities at a certain point in time? Whether it's the business owners, creditors, or anyone else who has vested or potential interest in the company, the primary way for these stakeholders to evaluate the company's performance and financial condition is through review of company's financial statements. Financial statements are the tool by which accounting information is communicated to business stakeholders. Financial statements report on the performance of the business over a specific period of time, as well as its financial position at a certain point in time. All the entries recorded in the system during the accounting period accumulate within the accounts, and the resulting total balances of these accounts are then reflected on financial statements. Today, we will go over the two main financial statements, income statement and the balance sheet. Let's get started. Income statement, also known as profit and loss, measures the company's financial performance and reports on its profitability over a certain period of time. This statement lists all revenue and expense accounts and their respective balances, and then reports net income or loss based on the balances reflected in these accounts. Take a look at this income statement, also known as profit and loss. Do these accounts and balances look familiar? This is the income statement for our hypothetical consulting firm that was created based on the 10 journal entries that we made earlier in the lesson. Let's take a look at the structure of this statement. Every financial statement will have 3 important lines within its heading that will reflect the following: name of the company, name of the financial statement, and the time period that this statement covers. In our case, the name of the company is Hypothetical Consulting Firm. Name of the statement is Profit and Loss. And the time period is January through December of 2021. It's an annual income statement. Time period is a very important concept when it comes to financial statements. Income statements report results of operations over a certain period of time. Let's move on and go over the main elements of our income statement. Income statement first lists income accounts on top. It then provides total income based on the sum of balances in all the income accounts. In our case, we only have one income account, which is consulting income. So our total income is equal to our consulting income. Hopefully, this $5,000 consulting income balance seems familiar. It's based on a journal entry to recognize consulting income that we booked while going through our 10 hypothetical business transactions. Since it was the only entry to book income in 2021, this was also the total balance that accumulated in our T account and subsequently reflected on the profit and loss report. In our example, we're dealing with a service business that does not have cost of goods sold. If cost of goods sold would be involved, it would be listed below total income. You would then have a gross profit line, which would be the difference between total income and cost of goods sold. A prime example of activity that would be reflected in cost of goods sold account is when a merchandising business carries inventory. At the time the business would sell that inventory, the cost of items sold would be transferred from the inventory account to cost of goods sold account. In our case, there is no cost of goods sold or gross profit lines. So after total income, our P&L goes on to list all the expense accounts and their respective balances. In our case, there are 3 expense accounts with balances that are based on several journal entries that were booked in December of 2021. Next, expenses are totaled, and then a difference is taken between total income and total expenses. You will then get either a net income or net loss, depending on whether your number is positive or negative. Our total income is $5,000, and our total expenses are $3,640. So our net income comes to $1,360. Based on this, we're profitable for the year. We made a total profit of $1,360. And this is how the income statement, also known as profit and loss, reports the result of operations for a business. Next, we'll discuss the balance sheet. Balance sheet is a statement that reports on the financial position of a company at a certain point in time. Take a look at our balance sheet that was prepared based on the 10 journal entries that we booked earlier, based on the transactions for our hypothetical consulting firm. We have the heading on top, which is comprised of 3 lines. Name of our company, which is hypothetical consulting firm. Name of the report, which is balance sheet, and the date as of which the balance sheet is prepared. Make sure to distinguish how the date reflected on the balance sheet is different from the income statement, which reports on operations over a certain period of time. Balance sheet reports on a financial position of a business on a certain date, not over a period of time. The balance sheet lists assets, liabilities, and equity accounts of a company and their respective balances as of a certain date. It's like a snapshot of a business at a certain point in time. The individual accounts of each category add up within their respective groups. From this, we get 3 group totals: total assets, total liabilities, and total equity. The most important point here is that total assets must always equal to the sum of total liabilities and total equity. Hopefully, it rings a bell that this statement resembles our accounting equation that was introduced earlier. As you recall, the accounting equation states that assets equal liabilities plus owner's equity. So the balance sheet presents the assets of the company, as well as the claims against those assets. There are 2 types of claims against the assets of the company. First category are the liabilities, which are claims by creditors against the assets of the company. The second type is owner's equity, which are residual claims of owners against the assets of the business. And based on the accounting equation, total assets must equal total claims on those assets. Let's move on and go over all elements of the balance sheet for our hypothetical consulting firm. Top of the balance sheet reflects the assets section. The assets section is split into current assets and non-current assets. Current assets are either cash or assets that are expected to be converted to cash within the next year or the next operating cycle. The reason current assets are grouped and reported in a separate subsection is that someone who evaluates the balance sheet can right away determine what portion of company's assets is comprised of liquid assets. In our case, current assets are comprised of the following: cash, with the balance of $4,330, and accounts receivable with the balance of $4,000, so the total current assets are $8,330. Our next section is fixed assets. As you recall, we booked 2 entries for the following purchases of fixed assets: computer equipment for $1,800, and furniture and fixtures for $2,700. Based on this, our total fixed assets come to $4,500. Because these items are expected to benefit the company for a number of years, they were not expensed. Rather, they were put on the balance sheet as assets, and they will be depreciated over time. The next asset reflected on our balance sheet is the $2,000 security deposit that was part of our payment when we signed the lease. As you may remember, we signed a lease for office space in December and made a payment for $4,000. That $4,000 payment comprised of the following: a $2,000 current month rent payment, which was expensed to rent and went to the income statement, and a $2,000 payment for security deposit that is expected to be repaid at the end of the lease. So this is an asset. This portion of the payment made its way to the balance sheet under the account type of other asset. Our total assets are $14,830. Let's move on and take a look at our liabilities. Just like assets, liabilities are split into current liabilities and non-current or long-term liabilities. Current liabilities are expected to be satisfied within the next year or the next operating cycle. Our current liabilities are comprised of accounts payable of $2,700 and credit cards, payable of $1,270. The transactions that affected the balance of accounts payable were the $1,800 purchase of computer equipment and the $2,700 purchase of furniture. Since the $1,800 portion of this balance was paid to the vendor before the date of the financial statements, our ending balance of accounts payable is $2,700. The balance in the credit card's payable account comes from the journal entry that we booked for professional publications purchase in the amount of $1,270. Total current liabilities come to $3,970. Under long-term liabilities, we have a loan payable of $5,000. As you may recall, this is the loan we had to take to continue operations. Our total liabilities come to $8,970. Now we get to the equity section, which is the owner's residual interest in the business. The first item in our equity section is owner's contributions. The balance comes from our very first transaction, where the owner contributed $4,500 to the business. We booked this transaction with a debit to cash and a credit to owner's contribution, which is an equity account. Since net income flows into equity, net income is the other account that comprises our equity section. Net income of $1,360 increased total equity to $5,860. Our total liabilities plus total equity equals $14,830, which equals to our total assets. Remember that on the balance sheet, total assets must always equal to the sum of total liabilities and total equity. This was a financial accounting introductory course. The goal of this course was to introduce you to foundations of accounting and help you develop basic understanding of the accounting concepts. Your job is to continue to learn, to build upon this foundation.